US jobless claims out this morning rose to the highest level since 2021, signaling widening cracks in the relentlessly robust labour market. This, as separate data out last week, saw still strong hiring numbers. Joining me now for a closer look at the labour market is David Blanchflower, Dartmouth Professor of Economics. Thank you for joining me this morning. So we're trying to get a really full picture of what's actually happening with the health of the labour market. Talk about some of the things that actually characterise whether or not we are in a healthy labour market.
Great question. Well, the thing that I would say is that people have made a huge mistake by believing that looking at the unemployment rate tells you anything. I've been working on that for 40 years. Turns out since 2008, to say this is an important fact, the unemployment rate no longer tells you about labor market slack in the economy. And the reason it doesn't is it's unrelated to wage growth. And what it does is it underestimates how much labor market slack there is, which explains why wage growth is not higher than it is. So if you look at the unemployment rate, everything looks rosy. But if you look at things like the labor force participation rate or the non-employment rate, that tells you a very different story. Unlike other countries, many of whom have seen declines in the unemployment rate as the US has, the US's non-employment rate is 3 or 4 percentage points below where it was in 2000 and is still below where it was in 2020. Which says to you that there's lots of people out there in the labor market who want work. Contrary to what people say that actually the labor market is tight, these people are out there looking for work to come back from out of the labor force, and their presence is actually what impacts wages, not the unemployment rate. And I wrote a book called The Wage Cut, which was all about that. That's not true anymore. So the story in the labor market is that there's much more slack than people think, much more slack than the Fed says that there is. And that explains the period from 2010 to 20, which nobody else can really explain. Why, when the unemployment rate went from 10.9876.543, did wage growth not rise? And the answer is that that's the wrong measure to look at. I have a whole series of papers on this. You should take that away from your thoughts, and you should focus on non-employment, but also on underemployment too. Those are the variables that we care about. But to say it in a particular way for your listeners, the unemployment rate tells you nothing about the state of the labor market since 2008. It used to, but it doesn't anymore.
And so you mentioned non-employment, underemployment, as well as inactivity then. How should that be shaping, especially Fed policy, given that that's one of the things that they look at the most when determining their monetary policy?
Well, it means the capacity of the economy to grow and create jobs without creating lots of high wages is much greater than the markets and most of your commentators seem to think. So it means the potential to basically expand is greater. It means that the view of the Fed that you've got to raise rates is wrong. And essentially, the markets are with me, because the credibility of the Fed and these commentators that I've just been listening to, who I don't agree with really at all, but the markets are saying this has gone far too far. And I think if you look at it today, they're pricing in 8 rate cuts starting in September through a year from September. So there's much more slack than people think. And what's going to happen is you're going to start to see really bad data. And the mistake from the previous commentator, the mistake was to say that central bankers look at the current inflation rate. That makes no sense whatsoever. And I was a policymaker who set rate. That's the last thing you want to do. What you've got to think about is, what's inflation going to look like in a year to 18 months' time? And today, the Bank of England raised rates with a forecast that says in 18 months' time, inflation is going to be way below the target at 1. Which means that it should have actually been cutting rates. So most of the commentary doesn't understand the nature of the labor market, doesn't understand how monetary policy is set. You never set, if you say to me, how should I respond to today's inflation rate? The answer is not at all, unless it surprised me. Did I think this was going to happen a month ago? Yes. So if it does this month, do I respond to it? No. So I care about what's happening going forward. And it looks to me that bad data is going to come, and the market's completely right to build in lots of rate cuts. And in fact, you may see, if the data gets really bad, you may see them pricing in even more rate cuts, forcing the Fed to respond. But the reality is, because the market thinks rates cuts are coming. That is stimulus. So as if the Fed does the cuts the markets have priced in, that doesn't do much. If they don't do it, then you'll see a market reaction.
As you mentioned, because they've already factored that in there. So then when you look at deflation, you said last year in your op-ed to Politico that deflation, not inflation, is the real concern. After a year's worth of rate hikes, do you still feel the same?
Well, there's a couple of things to say. I mean, again, the conversation sort of forgets this. If you go to 2008 August, where many of the conversations were like this, all missed the Great Recession coming. And the big worry then was about rising oil prices and high inflation. It was in the fives. Well, now five, is it 5.2 or so in August 2008? Well, wonder what listeners think it was in August 2009, minus 2.1. So it's not as if history can't repeat itself. And what happens is these base effects start to drop. Is the one this month wasn't that big. The next two are going to be pretty big. In the UK, they're going to drop a 2.5 next month. So the reality is that deflation, and the Bank of England today is actually forecasting deflation with a probability of about 25 or so. And if you look back, we have data for 800 years of data, and what you see generally in response to inflations of around 10 or so, in the last 800 years where these things happen, half the time there was a giant response to deflation. Perhaps not long lasting, but that really is the risk. I mean, people are sort of saying it's not this, but this was exactly what happened in 2008. So I think the reality is that below target inflation is potentially what's coming, especially if we see drops in oil prices. And we continue to see things like drops in lumber prices, which are back to pre-pandemic levels, drops in the cost of shipping, that's back to pre-pandemic levels after giant increases. So if you have that, I mean, the way I always think of it to people is prices go from 100 to 110 in the first year. That's 10% inflation. They go to 110 in the next year. That's zero inflation. And they go to 105 in the following year. That's deflation. Even though prices are 5% higher than they were in the first period, if you go from 110 to 105, that's deflation, and prices are still higher. So I think people have underpriced that, and the danger is that we will undershoot the target, and that forces the Fed to move. But the market's thinking that. The market thinks that's what they're going to see, which is why they've priced in 8 cuts, which I think is completely appropriate.
And I do want to ask you about sort of where the future of jobs are heading. We heard a lot about AI and whether it's contributing to sort of efficiencies as well. I just want to quickly play this clip for you from Robinhood's CEO.
I think that over the next few decades, every company will have to transform into an AI company. The companies that have been able to move ahead and create differentiated value have been technology companies. In the same way that every company sort of has needed to become a technology company, I think AI will sort of be embedded into the fabric of all companies.
Well, first, I want to know if you think that that is going to be the case, that it will be part of the fabric of all companies. And what does that mean then for the workforce if you do have this shift to greater AI?
I think he's probably right. The problem is that people have assumed, and if we go back to the Luddites thought that technology was going to be job destroying. But if you look back over, let's say, the last 25 years, actually lots of new jobs have been created around technology. You know, when you have your dishwasher repaired, the plumber doesn't come, the computer guy comes to sort of impact, to deal with the computer that's in every one of your machines. I mean, yesterday my coffee maker was blocked, and I got a message on my phone saying there's a problem with your coffee maker. I think that's the first thing. I think this is job generating. It's just job different. And I think, in a sense, your question is something I've thought about endlessly. But if you think, let's say I was to go back each 10-year period, and you say to me, so what do you think's coming? What are the new jobs over the next decade going to look like? And the answer is I would have had it wrong. It would have been very hard to work out that be an Apple store, and I'd be talking to Yahoo Finance on my Zoom. So I think the answer is it's hard to know, but I think this big change is coming. Obviously, we're seeing this technology impacting things. Zoom is a big deal, and we're seeing evidence that the inner city is in decline. So if you look at things like, you know, beeps of phones in downtown. In San Francisco, it's about 25% of what it was. In Boston, it's 50%. The character of working has changed. but jobs have changed, and we're seeing rapid change around this technology. In many senses, it may well be job enhancing, not just job destroying.
I think that is a good way to look at it. And as you mentioned, I mean, 3 years ago, no one was thinking about, Chat GPT and everything else changing things.
Right.
A big thank you. It's been great having you on. David Blanchflower, Dartmouth Professor of Economics. Thank you so much.